everybody. Welcome to the TraderMerlin show for your Thursday afternoon edition. Netflix earnings we will talk about here a little bit later on, but I tried to bring this gentleman on. I was planning on bringing him on every month because he does a thing for his students in the OTA community called the B.E.C.C report, which looks at bonds, equities, currencies, and commodities. And unfortunately, I'm horrible at scheduling guests. So I think the last time we had him on was in November when we did the November B.E.C.C report. Well, we missed December, and here we are in January. My guest joining us today, coming from the great state of Texas, Mr. Scott McCormick, CMT, which stands for Chartered Market Technician. Scott, how you doing today, my friend?
Any better, and I couldn't stand it. How are you?
Great. I'm good. Are you close to Dallas?
I am probably about a 15-minute drive door to door from Dallas Fort Worth International Airport. So I'm more on the northwest side of Dallas.
We should make a wager because I have a feeling my 49ers are going to stomp all over your Cowgirls this weekend.
Yeah, I don't know.
You don't even follow
what
football
the payout would be on that.
Yeah. I'm sure you could probably stomp on me with some of this bond, equities, currencies, and commodities talk. So let's start big picture and work our way down. Obviously, bonds are a major topic for global growth and expansion. We've seen the inverted yield curve. Anything changing on that front that's noteworthy from your perspective?
So when we take a look at like the bond side of things, and just looking at like the 30 and the 10-year in particular, we've put in a low over the course of the last few months and have continued to trade higher here so far this month. But when you're looking at it from a longer term perspective, okay, and again, I think it's really important for any of your newer listeners that haven't heard me on your program before. When I say long term, like I look at charts that go back as far as they can.
Yep.
Now, most data providers, when I'm using these futures charts, they only go back into like the early 2000s. And so when you're taking a look at the actual price of the 30 and the 10-year bonds, they broke a major uptrend going back into the second quarter of last year, April in particular. And so we've been in this kind of impulsive phase since then. But over the last couple of months, we've seen a bit of a bottom put in. Now, for those that are kind of new to bonds, when bond prices go up, that means that interest rates have been going down a little bit. So there's been a little bit of relief. The 30 years come down from about 4.4% to where it closed today at about 3.5%. And so when you are looking at it from the perspective of just kind of trend analysis, what we could be on the precipice of is entering into a new longer term bear market. I'm a little reluctant to go so far as calling it a secular bear market at this point, which could last over a decade.
Pertaining to bonds or to the overall equities?
Yes, to bonds. Okay. To bonds,
yep.
Right? But then the other part of that, the other half of that equation is that there is historically a relationship between bonds and equities, in that bonds typically lead equities, right? Whether it's to the upside or to the downside. And we actually did see that in the bond market as the bond market topped out in March of 2020. That's obviously a pretty long lead time going into the equity tops, but the bottoms here so far have kind of been the same as well, because we started to see a little bit of a low put in most of the equity markets there back in October and December.
When you say, it's funny because I'm flipping back and forth between the interest rates on the 10-year and the 30-year, and then you want to look at the underlying bonds like the ZN, or?
Yeah,
I'm bringing up the charts here to kind of follow along your discussion.
Okay, yeah. So if you're looking at the ZN, for instance, okay, so we actually hit an area of demand in and around, and I'm using the continuous contract, by the way. So there was an area of demand in and around like 109 to 108.06. And so far we've bounced pretty nicely from that area, which, if you're kind of the shorter term to intermediate term trader, so you like to hold positions for maybe several weeks to maybe a few months, this has been a nice little rally for you. But when you start to take a look at where some key areas of resistance are inside of the market, the spot that we actually saw a pretty big breakdown from, which is about that 117.13.5 area, that's going to be a pretty critical spot as the markets tend to kind of pause at those areas, because anybody that was long there before that did not get out during that kind of last push to the downside during August, September, October, going into those lows, they might try to cover some of those positions. Now, one of the other things that might throw a wrench into the works is the whole debt ceiling situation right now, right? So we've actually hit that today. Now, I'm not a bond expert to that degree. I can't really go into what all the implications will be on that. But, we are now in a situation where our politics are going to play into whether or not the U.S. will actually default for the first time ever. And if that were to happen, you would actually most likely see that bond prices just collapse and interest rates skyrocket because people are going to demand a higher yield on bonds that have basically defaulted. So it could potentially be a very interesting couple of months, because I think the deadline that I was reading about earlier actually doesn't go out until June 5th, where Congress has to make a decision as to how they're going to handle this. And right now, just politically, it's a hot wire.
Yeah, right? And I think, but I mean, let's be honest. You can't let it default. I mean, obviously, wants it to happen. And here is, just for those who are referencing, here is the U.S. debt has risen regardless of the administration. So I was just quickly grabbing for a graphic here. And again, this isn't a Democrat Republican thing. It just happened to be the image that I grabbed. There really isn't an administration where you've seen it decline. So that debt ceiling keeps rising and rising and rising. What's noteworthy, at least for me, is in the 80s to the 90s, it was, let's call it a 15-degree slope. You get to 2010 to 2020, and it's like a 50-degree slope. And now we're looking at like a 70-degree slope. So it's just getting steeper and steeper. And I think you're right. At some point, we'll probably get to the point where we do default, but we will most likely just keep raising and printing money to cover that, because if we do default, these markets are going to go to hell in a handbasket.
Yes. It would be, as you pointed out, unprecedented. And, nobody wants to be the party responsible for that, right? Neither side does. Regardless of what they say in front of the cameras, it's another thing behind the cameras. So as we continue to go forward, though, regardless of what happens on Capitol Hill, I think just, again, paying attention to these longer term trends and being mindful of where some of the key price points are, both in the long term and the short term, right? So as I go through and I analyze, let's say the 10-year, and I'll just kind of give your listeners a bit of a glimpse here into my thought process. So right now, if I were to just look at the daily chart, I'll note that, yes, we have an uptrend that is in place since the lows there in October. And so,
am I driving, or are you showing your screen?
Oh, I'm sorry. Well, I can.
I thought maybe you were talking to your screen. I'm like, if you got it, just bring it up there.
Yeah, I can go ahead and share my screen here.
You don't have to. I just figured you.
No, it's quite all right.
Easier than me driving. All right, there we go.
So here, and I'll take you guys back out to a monthly chart, right? So this was the area that I was talking about before, that 109 to 108.06 area. And so we've had a pretty sharp decline going into that spot. And there was a couple of areas back here that I was looking at potentially for a low to be put in. And we had a situation back in June of last year where we did rally for about a month and a half, almost 2 months, before continuing the overall downtrend that really started back there in August of 2020. And so as we're looking at where we are here today, one of the things that I do in order to figure out, okay, is this longer term downtrend over, and should we expect bigger moves to the upside, or do I still need to kind of look out below, right? So as I take a look at this, just going out here to the weekly chart, noting the critical swing high here. So as I go through and I look at charts, I always ask myself a couple of questions, which is, one, what's the trend? Two, where would that trend terminate? And three, where would that trend continue, right? So if I know that my bigger picture trend is down, I'm looking at that 122.02 area, noting that the overall trend is down and we have a short-term uptrend. So what that tells me is that it's corrective in nature. So when it's corrective in nature, it tells me a couple of different things. One, the short-term trend is going to be up, but it could also be choppy. Whereas if it was impulsive, it's typically just kind of one direction and very quick. So that kind of gives me a sense as to how I might want to handle an environment like that, how I would, ultimately like manage the trade. But one of the other things here that I would be paying attention to is, again, the shorter term trade here that you see on the daily chart. So as we take a look at, where the kind of short term trend is, we actually have the swing low here that was confirmed as of yesterday, sitting at 111.28. And I say that because yesterday we had a close that was above that prior high candle here.
Right. Mm-hmm.
And so technically, as of yesterday's close, you put in a higher high and you've confirmed this higher low. So what does that tell me? It just tells me that right now, this corrective phase, it's continuing, right? So the other part that I typically go through is say, okay, well, if I know that this is a bigger picture downtrend and I know that I'm in a corrective phase, how far was the last correction? And so I would just identify that on my chart and simply measure how far that went. I typically focus more on price as opposed to time, because sometimes price and time are symmetrical, which means that not only does the amplitude of the move reflect what happened before, but also the duration. And so as we take a look at this, I could see that this last correction went from June of 2022 until August of 2022, so roughly 2 months. But we have kind of surpassed that point because technically we should have topped out based on time last month, but we haven't. We actually made a new high. The thing that I tend to focus on more is the price side of the equation. And so when I look at this, just measuring how far that rally went previously and projecting that from where that low is, I can see that, it gives me a target at about 116.21. And the other thing that I also pay attention to, of course, would be where are the areas of supplier demand inside of the marketplace. And so we're talking about this inside of our morning broadcast that we do every day for our mastermind students. And, we've basically come up to this area here at about that 115.19 to 116.23 on the continuous contract. So as I'm seeing this, the fact that we have this bigger picture downtrend, we've had this corrective phase, the corrective phase has gone as far as what it has before, then there's a chance that this kind of impulsive move here that you see on the daily chart that's been in place since late December might terminate. And so one of the important points that I would watch here would be this 114.09.5. So as I watch this, I have to remember that trends can continue and they will until they reverse, right? And so again, where would that trend terminate? And that trend termination point would actually be here at about 114.09. So I might sit on my hands until that takes place. And when it takes place, I could start taking a look at, opportunities to sell short. Mm-hmm. And if that were the case, if we were to actually see bonds continue to decline, I'd have to be mindful of the fact that we do have a demand zone there. But just like we have those measurements there for the prior corrective phases, I would also measure the prior impulse and project that from wherever that high is. Right now, I don't know where the high is until the swing high is actually put in place, which hasn't happened yet. But just projecting that from where that was, 100% projection would actually put bonds down at around 103. And so the implication there, of course, is that we would actually see interest rates move up pretty substantially. So if we were to compare,
and just real quickly for everybody, when you're it's great. I love it. I'd like to bring, you're very technical and I love the geeky side of the analysis. But in layman's terms, he said earlier that bonds are a leading indicator, if you will, of the market. And remember, he's talking about having the price of those bonds is rallying up into supply. As bond prices rise, yields are falling. Falling yields are bullish for the equity market. So if we continue to see that trend to the upside, that short-term corrective phase up to the upside, that means bond yields are expected to keep going down and down and down, which would be bullish for the markets. However, if the supply zone that he's identified there does hold and we see the price of bonds start to fall, that means that the yields are going to start to rise, and that could put more pressure on the equity market. So I know a lot of people say we're out of the woods, it's clear sailing. Not necessarily, right? There are certainly a lot of factors which could move these markets. And, I have here's the yield on that 10-year on a weekly. We topped out back here in October of getting, was it 4.3, 4.35. Yeah. We get much higher than that. And again, that's going to start to really squish businesses. And back in November, Scott was saying, 7% might be a target there based off some of his analysis. And again, if that trend on that 10-year that he was showing, the bond continues to slide as it was aggressively, then 7% becomes a very real reality. And I'll tell you what, if we get to 7% yields on 10-year bonds, your housing market's going down in a big way.
Yeah. And so, I mean, there are some major implications here from a broader economic sense,
Yep.
and, just to kind of tack on to what you were saying, if I measure, what the move was in yields from the lows there in August to the highs here in October, that went from 2.5% up here to 4.3%. Okay. So we're talking about a 1.8% rise. And if we kind of add that in to where we are here, that's going to put that at 1.8%. So
on top of where we are right now, it'd be at 5%.
Yeah. So exactly. So I don't know why I'm trying to do the math in my head. That's why I have this freaking tool here. So as we take a look at that would, let's turn that off. That would give us a target on yields in and around 5.1%.
Mm-hmm.
And when you take a look at the last time we were in those areas, that's going back here to 2007, right? Yeah. So one of the things that I would encourage people to think about, especially those that have been around a while longer, right? So those that are kind of more that millennial and Generation Z who were watching their parents kind of freak out back in 2007, 2008. I'm not saying that that's exactly what it's going to be, but there were some opportunities there to be a buyer in that environment. And there are people who bought homes back then that had interest rates on their mortgages in around 5%. It's just that the rest of us that have been in the real estate markets over the past 3 years or so, we're a little bit lucky if you're kind of buying your homes back in 2019 and 2020, because you were literally buying with mortgages at decade lows. This is the chart on interest rates going back to 1962. And this is the inverse image of the bond market. And this is why I say that there's a chance that we might actually be entering into a longer term bear market on bond prices, bull market and yields.
Right.
And just as a point of reference, when you take a look at where this last kind of bullish phase, terminated, there's an old saying that old support can become new resistance, and that would actually put you in at about 9.4%. But there was also another kind of critical swing low here that was sitting in at around 6.8%. And I think that's maybe where I was getting that 7% number from. But so we're not out of the woods, no, right? I mean, we've seen the CPI dip, we've seen the PPI dip, but it doesn't mean that the reign of inflation is over. We still have supply chain issues, which is half of the equation of supply and demand, right? And as long as demand remains strong, then you're still going to see inflation until that supply chain resolves its issue and starts to kind of flow the way that it was kind of pre-pandemic, right? And we're just not there yet. So, but those are, that's what the treasury side of the bond market is basically showing me at this point.
That's the B. So on the Beck report side of things, we could do a 2-hour show today. We have bonds was the B side. Equity markets, this is the one I think has the most, diversion of opinions, right? Some people are saying we're going back to all-time highs. A lot of people saying, hey, we are going to tank even more from here. I actually do a thing at the beginning of the year where I ask everybody to give their year-end forecast for where they think the S&P is going to be. What's your take on the S&P at this point? And if you really want, what's your forecast for the S&P for the end of the year? I'll put you on the list.
Yeah. So I think the end of the year full forecast is a fool's game.
Damn it. Don't rain on my parade.
No, so I've always kind of joked around that I'm an equal opportunity trader. If I was a mercenary, I'd just go with the side that's paying me the most. And that's basically what my job is.
What are you, Italian?
So as I'm taking a look at this, right, and again, when I go through and I do the Beck report, I'm looking at charts, and I'll just kind of freak out your viewers / listeners here for a moment. This chart goes back to 1960, right? And you can see I've got this thing marked up going all the way back to whatever that high was there back in 1962. And so to me, it's
born yet? Were you born back then?
no.
Okay,
As a matter of fact, so so here's a little bit of fun. Right in here is where I was born.
Wow,
right.
Okay.
So as we take a look at this, and unfortunately, I did not open up my account then. I had to wait until I was
You know what?
18.
I need to talk to your parents. Shame on your parents.
But either way, as we take a look at this, you're going to see that there was a couple of major phases here within the equity markets. We had this is an example of a secular bull market. And I have the lows here in 1975, but most say that like the bull market started back in 82. And continued here until 2000, and then of course we had the 2000s through here in 2013. Although most people reference the low there in 2009, the actual breakout didn't take place until 2013. So technically, even though we had a cyclical bull market, it didn't become a secular bull market again until those highs were made back here in the second quarter of 2013. Now, the reason why to me all of that is important is because we have been in a secular bull market phase basically since then. And that, from a time perspective, if we consider for a moment that a secular bull market tends to last 18 to 20 years, and we know that the last bear market low here was back in 2009, tack on some numbers here. Let's just kind of save my brain here for a moment. And, we go out to 2029, right? Which is way out here. I can't even add that.
I don't think it'll let you get over there.
I've got to add some distance over there. But so from a time perspective, again, we've got a long ways to go. But the reason why that becomes important to me is because it also tells me too how these kind of sell-offs that you've seen, for instance, back in 2010, 2011, 2015, here in 18, and even in 2020. These are very kind of short-lived and shallow relative to the moves that we saw during the secular bear markets that took place during the 2000s and even here in the 1970s. Okay. So as I go through and we take a look at this, the thing that I'm noting is that, that secular bull market has not terminated yet. The long-term trend line is still in place, even though you don't see it here. I've drawn it many a time, but the long-term trend is still in place. As we kind of zoom in over the course of the past year, you're going to notice that, yes, we've been in this bearish phase, which is corrective relative to that longer-term bull market. And what I'm looking for right now is the termination of that correction in the beginning of the next impulse phase. And so when you start to look at some of the critical swing highs here that would actually indicate the termination of this bearish phase, the key one that I'm watching is the high here from August of this past year. And I apologize, my computer's kind of lagging here a little bit, but we've got about 4,300, I think 4,340 and change. We get a monthly candle that closes above that area. I'm going to become a little bit more bullish on the market, but until then, I have to remain fairly neutral, because here, that 4,300 area down to about 3,500, it's created a range that has only actually tightened here over the course of the past month or so. Because ultimately, when you take a look at a monthly chart, for instance,
the past 3 months. I mean, really, October, November, December just become more consolidated and almost forming a pennant formation.
A bit of one. I was doing a stock XLT yesterday, and I started to draw one, and I'm like, it's kind of. I started to focus in on the triangle, and I'm like, not quite a triangle,
Yeah, close enough for me.
Yeah, exactly. So, but as your viewers can see here, this has just been going sideways now for the last couple of months, and even still, if you look at the price action here from September, all of October, November, December, and so far the month of January, we are still trading inside of the range of that 1 month's candle, and that's just amazing. So to me, again, all of that is corrective in nature. If this were a full-on bear market, you would see very large impulsive moves to the downside, much like what we saw back in 08, early 09, and we're just not seeing that type of behavior. So it makes me a little little cautious about hopping on to the, well, the markets are going to decline another 20%. Now, if they do break down, trust me, I've got my levels that I watch that will let me know, okay, yep, here's my line in the sand. The market is breaking down. It's okay as a shorter term trader to start hopping on that train. But from a longer term perspective, I'm remaining fairly neutral here. And this will actually kind of bring me over to one of the other things that I typically look at from a longer term perspective. This is the percent of stocks that are above their 200-day moving average on the S&P 500. So what this indicator does is it looks at all of the 500 stocks on the index, and then it looks at whether or not the stock is above or below the 200-day moving average. If it's above, it'll kind of add that on to this number that you see over here to the right. So basically 51.9% of the S&P 500 is above the 200-day moving average, which is generally considered bullish, right? Now, what you'll notice here is that you've got the 70, the 30, and the 50. I just put the 50 there as just kind of the midline, but below 30 tends to be a little bit more bullish. Above 70 tends to be bearish. And you have to be careful about that because, it was above 70 all from October or November of 2020 going in through September of 2021, so nearly an entire year. But those that are familiar with divergences would note that there was a massive divergence that took place over that period in time. So a bit of a warning. But here's where I'm really going with all of this. When we look at this information, and granted, it only goes back to 2010. But you'll notice that we've actually put in a reversal here on the percentage of stocks making their 200-day or below their 200-day moving average. And so when we take a look at this, you'll notice that we've put in this W pattern here indicating a reversal, right? So this tells us that right now there are, again, more stocks above their moving average, the 200-day, than below. But you'll notice that the S&P 500 has not broken out quite yet, right? Because you would think, okay, well, that indicator is going up, so the prices should be going up. Well, they have been, but they haven't taken out that prior high that we were talking about earlier, that 4,100 up to that 4,300 area. Now, the last couple of times that we actually saw a W pattern put in on this indicator were back here in that 2015, 2016 correction. It was a little bit more of a sideways market. But ultimately here, we put in that reversal, and you started to see that the market moved out of this corrective phase and back into a multi-year, bull market, basically, within the context of that bigger picture bull market we were just talking about. Previous to that, we also saw another bit of a sloppier W pattern, but this was back in 2011, going into early 2012. And here we saw another one as well. That was back in 2010, which kind of, coincided with that bull market phase there, which lasted only about a year. But these are some of the things that I'm watching here on the equity market. So there are some bullish signs here on the equity front, but we're just not out of the woods just yet, right? So again, this area here at about 4120 in the short term, but basically this 4325 is going to be a really critical area here for the S&P, in my opinion.
So it feels like you're saying choppiness, unclear, unless we get above 4,300 or below 30, call it 30, 3,500, and just range bound for that period of time. Because I too have felt that this is going to be a rather choppy year, with no real clear direction. And if that happens, then I guess you just have to implement the right strategy to capitalize on that one. But for those that are big bullish, buy and just hold forever, well, you might not see that until we get above that 4,300 level. At least that's
right. Yeah, because the easy sailing, if you will, kind of like what we saw in later 2020 and most of 2021, that's not going to happen until we take out some of those highs. It's probably just going to be choppy and sideways. But you plan for that, and as a shorter term trader, it could be a pretty beautiful year. Just swing trading the stocks back and forth, as opposed to just being more of a buy and hold.
All right, we're halfway through. Scott loves to chat. It's one of my favorite things about you. You just love to. You're like me. Once you get started on a topic, you look at the clock and go, "Oh crap! I spent 45 minutes talking about something," and I loved it.
You put me behind a mouse and a chart, man.
Good
Forget about
stuff.
it.
We love it. I love it. I'm just, hey, trust me, I'm just sitting back here watching and learning as well, always absorbing information. So we got bonds, equities, and then you got currencies and commodities. I'll let you start where you like to start there. A lot of people looking at the commodities side of things, and well, that's the main reason inflation is in check. I don't know if that's necessarily true. I think it's certainly been a factor to help with that, but maybe there's something on that commodities or currency front which you want to discuss as well.
Yeah. So on the commodity and then currency front for our Beck report.
I always get the order wrong.
Every month.
It's commodities and then currencies, right?
Yeah, it's commodities and then currencies. And the reason why is because it goes back to a model that I had to study in the CMT program that talks about the asset class rotation as it goes through the economic cycle. We see the bond shift first, and then that has an impact on equities. And as demand for industrial goods and services and so forth comes into play, we see the impact on the commodity side of things, right? And so here you should actually have a chart of the Thomson Reuters.
Oops.
And it used to be Jefferies Commodity Research Bureau Index. This is the one that I like to use for the commodity analysis because it tends to be a little bit more balanced compared to some of the other commodity indexes, which are either too heavy towards metals, too heavy towards energy, too heavy towards grains. But ultimately here, there's a couple of things that have really kind of happened in commodities over the course of the last couple of years. One, we had this multi-year, almost decade-long downtrend that was terminated. And we saw a really impulsive move here from those lows back in April of 2020, going up to the highs here back in May of last year. And since then, we've been in a bit of a corrective phase. And here you'll notice that we've actually been in a range since September. Sound familiar?
Yep.
So we're just kind of in limbo right now. And so until this thing either breaks down or breaks out, it's anybody's guess. Now, taking a look at where the demand is inside of this marketplace, the next area that I've got here in demand is sitting in around 232 to 219. And that does coincide with a 100% measured move of this initial decline here projected from the high just a couple of months ago. But on the other hand, if we do break out to the upside, we do have some supply here, but my measured move targets are north of that, which would take us in around that 378. And I think I've got another area that's sitting up here at about that 407. So I'd be a little more inclined to watch that 407 area. And, speaking of commodities, one of the commodities that we had talked about previously was copper. And let me see if, for whatever reason, this one workspace is just kind of lagging here a little bit. It's a little odd, but
I love TradeStation.
I was going to say you got to love Zoom because everything else is running just fine. So we had a major low. I don't know if you recall talking about this or not, but going back into 2020, we had a major low here in copper, and this thing just ran from like $2 all the way north of 480. But there's an old adage in the market about copper, and that copper puts a ceiling on the economy and it puts a floor underneath it.
Yep.
Okay. And one of the things that you'll notice here is that over the past 3 months, we've really, and I should go back to July. So let's call it the last 6-7 months. We've put in a major swing low here, and we've advanced quite nicely. Now, we're not quite out of the woods here just yet, because in the lower time frame charts, like your dailies, there are a couple of areas of supply here where copper might slow down. But ultimately here, if we do have this major swing low that's been put in place, my next measurement here on copper is actually up here at that 625 to 621 area. I know it's crazy, right? So from an industrial standpoint, that might be a good sign for the economy. But going back to our earlier part of our conversation about inflation, if we do see that these commodity prices continue to move higher as a result of inflation, that only kind of further supports the case for continuation of an increase in interest rates, a decline in bond prices. We could see similar situations in the equity market where we just end up in a long-term sideways market, like what we did back in the 2000s. So there's a lot of longer-term implications here when it comes to this. So it is something for us to watch. But ultimately, unless we take out this low here at 311 on copper, I'm continuing. I'm looking for this thing to continue to trade higher, because even from this swing low right here, which is the major swing low that we had back in 2016, measure move target based off of the 2008 to 2011 rally actually puts us out there at about 533. So even if we don't get to that 625 area, I'm still expecting prices to continue to move higher here. Now, again, going back to what I was showing you guys earlier on the bond side of things, as I look at this, yeah, my longer term trend is up. I've been in this corrective phase. And so I would want to know, have I terminated that corrective phase? And one of the things that has happened here is that we've put in a double bottom here on the weekly chart, which is a major downtrend reversal pattern, which suggests that I'm back into an impulsive phase, which is why I measured the last impulse from the March 2020 lows going up here to the March 2022 highs. And now have to assume that, okay, well, if this trend continues, where's the swing low that copper would have to trade below in order to indicate that this is not an uptrend and maybe we're actually moving back down? And so that would actually be in around that 354 area. And if that happens, chances are the CRB would be breaking down, and we might actually see copper get down at around that 244 area. But you can see there's possibly another test of that 212 area, as we do have some other measure moves that kind of coincide with that. But
yeah, 244, that'd be a hell of a drop.
Right. Yeah. So that's like one of the major things here that I'm seeing on the commodity side. And of course, gold has caught a bid, recently. And when you take a look at the continuous charts here, it's a very interesting situation. Just taking you guys out to the monthly charts. And the reason why I say that this is an interesting situation is because we did break down below this kind of critical swing low from March of 2021. We closed down below that area here. So it's really kind of calling into question whether or not we make a new high, which would be about that 2078. And again, this is the continuous contract. So if you're trading front contracts, your prices might be a little bit different. But if we do manage to actually see an equal size rally here to this last impulsive phase on gold, that actually gives us target at about 2,500. But before that, we have this prior major impulse here that preceded this correction, which gives us a measured move in and around this 2,200, almost 2,300 area on gold. So it's going to be interesting again to kind of see what that looks like. But going out here to the daily chart, again, we've put in a major reversal here on the daily and the weekly chart, and taking a look at where the most recent kind of swing low is here on the weekly chart. You got to come out to this area here at about 1719. There's some swing lows on the daily chart that are a little bit lower, or a little bit higher rather, but on the weekly chart, that would really be the area that I'd be looking at.
Nice.
So
let me answer this question from Naum. Naum says, so the 625 area in copper, Scott, forecast, not predicted, forecasted using Fibonacci retracement. No, it's not Fibonacci retracements. It's using measured moves, which is using the same tool. And Fibonacci is simply just the percentages of a move. So when you look at the 38 and 62, all that's fibs. 61.8. That's gonna be Fibonacci. The measured move is what he's using to say, okay, it moved this much in the past. Based off of that, how much should it move here?
Yeah, so they're equal measured moves. So if anything, it's just 100%. So if the last move went $50, then I would expect the next move to go $50, right? There's no real application of Fibonacci ratios to that number, unless you're a purist and you say, well, the number one is a Fibonacci number, and you start to go down that path. But I will look at applying the Fibonacci extension. I do look at some of the other ratios and some of the derivatives of the ratios to identify areas of confluence. But the first one that I always focus on is 100%.
Yep. As do I. Talking Monkey says, Dr. Copper, are there times and situations where copper disconnects from the market's prediction, like as you mentioned, inflationary times? So I guess maybe when do you see a disconnect there with copper based off historical?
I haven't studied copper that deeply to where I could answer that question. As I go through and look at it with just my novice mind, I haven't gone back and said, well, the period of 2008 to 2011 was inflationary. I couldn't even tell you what inflation looked like during that period in time. It was probably closer to disinflation. So as I go through and I look at this, I just know that generally speaking, rising commodity prices typically is inflationary. One of the things that I would need to be mindful of would be the strength of the dollar, because that could certainly play into the performance of commodities. So for instance, if I were to take a look at the dollar index has recently put in a high. And as that has happened, and I keep hopping back and forth here on my screen. I apologize.
That's all right. I'm good. So when you say recently put in a high, you mean like back in September of last year?
Yeah. So
we're on a pretty nice pullback into demand right now.
Right. So when we take a look at the high here, we had a high that was put in September.
Mm-hmm.
Okay. And so if I were to relate this high here, and you got to love cursor tracking, right?
Yep.
So I have this high here in the dollar index, and prices have declined. And over the period of that, 3-4 month period, I've seen commodity prices go up. Okay. So there's an inverse correlation there between the dollar strength or weakness, in this case, dollar weakness, commodity strength. So as you just pointed out, we're back to a monthly area of demand, which, by the way, also coincides with 100% extension of that prior corrective move projected from this high that we had in September. So if we do put in a low here for the dollar, and we see that kind of downtrend on the daily chart actually terminates and starts to move higher again, then I would actually expect to see that we have more of a weakness kind of come into the commodity side of things, and maybe going back out to this chart, we see that the CRB breaks down below 264, right? So hopefully anybody that's kind of listening to this right now can really start to see how some of these pieces kind of fit together. And I wouldn't necessarily, just hop into it and be like, okay, well, I'm bullish on bonds, I'm bearish on stocks, and just buy and sell accordingly, right? No, I would look at these things and I'd say, okay, where's my line in the sand? Where's that piece that is going to say, okay, now I've got the evidence that is backing up my thesis here, and it's time for me to take action. Because if it doesn't happen, it doesn't happen. It just means that, whatever's happening before is still happening. And what I'm expecting to happen next hasn't happened yet. Right. And it just, forces me to go back to the drawing board, which I do every month.
We like the drawing board. Drawing board's great.
And yeah, look at my drawing board.
And when I look at your screen, it really is a drawing board. There's a lot of stuff there. And I think for some of you that it might look a bit overwhelming and confusing, but as someone who's done this for a long time, he's got it down to a science. And I'm sure when you zoom in, some of those levels start to overlap and show some confluence.
Oh, I had to clear out some of these earlier before I came in here. I'm like, wait, where's this one coming from again?
Funny how that happens.
Right?
Awesome. Well, hey, I apologize for not getting you on in December. I like having you on more frequently than not, just because there's always such a wealth of information that you give. What's your teaching schedule like? Obviously, I've got some people who are OTA graduates who would already know where to find you, but where can others find you within the confines of OTA?
Yeah, so I would say that if you enjoyed this type of analysis, I do kind of a scaled down version of that on a daily basis, because there's only so much time that I have allotted. But every morning, Monday through Friday, unless it's a holiday like we had this week, I'm in the guided pathway sessions from 7:50 a.m. Eastern. That would be 4:50 a.m. Pacific, until about 20 after the hour. I go through and I look at I look at the 4 equity indexes every morning. I look at the 10-year and the 30-year. I look at 3 of the major currencies. So the euro, the British pound, Japanese yen. And then I wrap it up with looking at commodities. And so I do that every day from kind of more of the intermediate term perspective. So I'm using like daily and 4-hour charts, but anybody that pays attention to like the cycles of it, these are typically trades that would last several weeks to potentially several months. And that's my usual routine, right? Now it just so happens that I'll be teaching for the first time in probably a year the stock class for the week of January 30th through February 2nd. So it's a 4-day class, and I'll just be taking you guys through basic stock selection, but also how I use concepts like relative strength analysis, which I didn't even touch on today, to help get ideas as to which asset classes or which sectors might actually be beneficial to hold inside of a portfolio.
Nice. So GPS, that's going to be Monday through Friday, as you mentioned, 9 or 7:50 a.m. Eastern Standard Time to about 8:20, right?
Yep. And then there's another instructor that comes in after me, giving very specific kind of shorter term trade setups, but on a day-to-day basis, that's where I'm at. I get to give the bigger picture, and then somebody gives the shorter term stuff.
Nice. And a physical stock class going on at the end of January. If you guys want
online.
more,
I'm sorry, online.
Online. Yeah. Oh, I said physical. I meant to say an actual class, as far as a dedicated class. And you can find out more information by going to tradingacademy.com. If you are new to OTA, just go to tradingacademy.com to find out more information. And then I think that's going to wrap it up for me. I thought I had one more question. Oh, there was a question from Agent Sancho. He says, Scott, do you keep mental notes on all these charts? I assume you have data entry on all of these. I'm going to go out and answer it for you. His charts are the data entry. I mean, he keeps those
my
lines.
charts are my notes.
Yeah. No notebooks with written notes.
Yeah. So I think that the thing that I do, right, is that when I have cash to put to work, I always go back in and I review these charts, right? So I do these every month, and I'm updating the bigger picture. And a lot of the times nothing changes. But when it does change, I'm prepared for it. The other part is that when I've got cash to put to work, I always go back in and I double check to make sure that nothing has changed between, the infusion of new capital into the markets versus when I last looked at the charts, because maybe something has changed. Maybe there was a big market move or something that changed the structure of one of the markets I'm looking at. But these, as you saw on the charts, these are my notes.
There we go. All right, Scott. Well, hey, thank you so much. I appreciate you taking the time to come on. I know you got a million things going on, but love hearing from you. I hope you have a good start to your 2023, and I'll do my best to get you back on here soon.
Sounds good.
Awesome. Thank you so much, Scott.
All right. Take care.
Guys, Scott McCormick of Online Trading Academy, giving a little bit of insight into bonds, equities. I've got it backwards. I always say bonds, equities, currencies, commodities. It's actually bonds, equities, commodities, and currencies. I will fix that and make sure my slides will read that from now on. So hope you guys enjoyed that. It's funny, I was just sitting here just staring at his screen, watching his charts and his analysis, because anytime I have a guest on who has that kind of skill set, I love to look at it and see, hey, is there anything from there I can maybe use to my advantage and help me in my overall trade forecast or prediction or anticipatory trades I'm going to be making. So awesome. All right, I'm going to wrap things up. I didn't realize we were going to go that long, but Scott loves to talk, and honestly, I'm not going to stop him. So here is the chart for, let's go to Netflix, just because that one has been absolutely, I called it the popcorn trade of the day, NFLX. There's your Netflix, and it doesn't look like much, right? It was down 3%. There you go. It was actually a pretty ugly down day, down 3%. But when I go in here and do it on a 5-minute time frame and show you extended hours trading, look at that. There is right going into the close, and now let's look at earnings announcement. Boom. And remember, I said, it could swing 10%. Well, from the low here, it hit 313, and the high was up at around 345. So you actually had a huge 10% move straight up in a period of 5 minutes, and then gave most of that back, slowly drifting up now. Well, not most of it back, but give some of it back. Right now up about 7% in the after-hour session at 338. Now, here is the calendar for earnings, just so you can see what happened today, and I'll rush through the end here. Their numbers were not good. Apparently, I didn't read the final output here, but they missed earnings bad. They were supposed to make 47 cents. They came out at 12 cents. Whoops, we missed there. Down 74% with regards to earnings on the surprise there, but they were up significantly after our session. So that's pretty awesome. Yeah, right? It's fun. That's why I call it the popcorn trade of the day. I love watching how crazy those things are when those announcements come out. It's always exciting. Notice a lot of red here, though. You had Procter & Gamble. They beat earnings, but were down almost 3%. KeyCorp, they missed earnings, down almost 5%. Comerica, they beat down up 5%. And what was else is here? Fastenal. They beat earnings, down 1.5%. So an ugly day with regards to earnings announcement and just the I guess, a lack of predictability with those numbers. Now, here's what's happening for tomorrow. We still have the World Economic Forum, but I didn't put much attention on that one. If you look at the U.S., we have FOMC members speaking tomorrow. You have Harker and Waller will be speaking tomorrow, and then existing home sales to see if that is in fact slowing down as much as everybody keeps talking about. You can see the forecast here expected to go from 4.09 million to 3.95 million. That may have an impact on your markets tomorrow. And lastly, here's your earnings counter for tomorrow. Ericsson, Schlumberger, Regions Financial, Huntington Bank Shares, Ally Financial, and State Street. So more banks coming online with coming online with their earnings tomorrow. That's all BMO, or before market opens. And that, my friends, will do it. I was going to go deeper and more into some stuff I had questions on, but I'm out of time. We're at 51 minutes right now. I have a few questions that came through from you guys that were posted on the YouTube page, as well as some that were sent directly to me at TraderMerlin@gmail.com, which is on your screen right now. I will get to those on tomorrow's show. Of course, it's Friday, which means I'll be lighthearted with a glass of whiskey in hand. Hopefully, I'll see you guys then. If there's something that you want me to cover or discuss, let me know. Put them down below any of the YouTube videos, and I will get to those comments, add them to our slides, and hopefully have all those ready for tomorrow's show. As Lisa says, hit that like button. Doesn't hurt anything, doesn't cost you anything, and share it if you'd like to have somebody who might be interested in the macro picture. That said, have a great Friday, everybody. I will see you tomorrow. Take care.